Hello, I'm Graeme Bibby, Chief Investment Officer. I'm here today joined by Cedric and Henry Willans from Goldman Sachs Alternatives. Firstly, we'll talk about Partners Private and our approach. We believe that individual investors deserve better. We do this through accessing institutional quality investments with a strict governance framework and selection process. Over the last 12 years, we've accessed over 500 million of alternative investments in the private markets. So why private markets investments? Well, they simply perform better with lower volatility. That comes with some caveats though. You need to select those assets very carefully. And the areas that we like are middle markets, value add, and strong operator input. And we also like to look at the market cycle as well. So we look at strategies across core to value add in every asset class. So this can be like property, where you have a core property, which might be a fully tenanted house that's fully leased. You might then invest in something that has a little bit of renovation to do. Or it might be major renovation into the value add area. Or it might be opportunistic or special situations where you might be looking to redevelop that property or reposition it. So this strategy can apply across every asset class. We have an investment committee with a wide variety of backgrounds, including legal, financial, private bank, and institutional investments. And we have a thorough investment process that goes from sourcing investments with external outbound research, bringing that into a shortlist, then going through a rating process. We do investment due diligence, operational due diligence, financial and legal due diligence across every investment. We rate those investments and only improve the very best of those. I'd like to introduce you to Henry Willans and Cedric from Goldman Sachs Alternatives. With the infrastructure fund, could we run through what the key characteristics are?
Absolutely. Thanks, Graeme. My name is Henry Willans. I'm a Managing Director, Global Head of Infrastructure Secondaries, and an investment committee member for the Goldman Sachs Vintage Funds, which is the firm's secondaries investing business. We're excited to bring to market today the open-ended West Street Private Infrastructure Fund. This fund provides access to the best of Goldman Sachs's infrastructure investing franchise. Firstly, our direct infrastructure business, which is focused on value-add opportunities in the middle market. Secondary, our leading infrastructure secondaries business through our vintage platform. And then thirdly, our liquidity management capabilities, that the firm has a lot of experience in as well. The fund will target gross returns of 12 to 14%. Those are fully hedged in Australian dollar terms, and more than 10% net, with a meaningful quarterly yield component. The fund is also disclosed as SFDR Article 8 Plus. This is a reflection of the sustainability characteristics of the fund. Turning to the next slide, the fund is expected to be composed of about 50 to 70% direct infrastructure investments, about 15 to 30% infrastructure secondaries, and 10 to 20% in liquidity sleeve in those liquid assets. From a geographic perspective, we would expect about 90% of the fund to be in North America and Europe. And we would expect the fund to follow some of our key thematics, those around energy transition and utilities, digital infrastructure, transportation and logistics, and then finally, the circular economy. The fund will have a fully formed portfolio at launch, and I'll hand over to my colleague Cedric to talk a little bit further about that.
Hi, I'm Cedric. I'm a Managing Director at Goldman Sachs for the Direct Infrastructure Funds business, and I am also an investment committee member of our infrastructure fund. As you can see on the slide, we're going to have a fully formed portfolio at launch across all sectors. So, as Henry mentioned, energy transition with 4 seed investments, circular economy and other with 2 seed investments, 2 as well for transportation and logistics, and 2 for the digital infrastructure. I will also mention that some of those investments have been made 3 years ago already, and then some are more recent or just closed.
Okay, well, maybe we can go into some of the questions about the fund. Noting there is a track record of the closed-end funds, how will this translate into the open-ended fund performance?
Yeah, no, absolutely. So we are a global mid-market value-add infrastructure fund from our direct strategy. And so what that means is we are very active investors, and what we expect to do going forward is more of the same. So the investors will have exposure to our flagship fund alongside us as we deploy more capital and do new deals. We intend to focus on the same 4 verticals that we mentioned earlier, so energy transition, circular economy and other, transportation and logistics, and digital infrastructure. What is really important to us is the characteristics and the infrastructure characteristics of the businesses and assets that we invest in, which means defensive and long-term cash flows, strong market position, high barriers to entry, and assets and services that are really critical to society. We think this provides an attractive risk-return opportunity through the strong downside protection that comes with it, and also the ability to add value along the way during our ownership period up until exit.
Thank you. Well, following on from that, what are the differentiation that Goldman's brings with this fund compared to other infrastructure funds with competitors out there?
Yeah, look, Graeme, I think one of the key elements of it is our infrastructure secondaries capabilities. The Goldman Sachs vintage funds are one of the largest and longest standing investors in secondaries globally. We have invested more than $70 billion in more than 650 transactions over the last 25 years. We have a global team of more than 80 investment professionals. On the infrastructure secondary side, specifically, we made our first investment in 2008, so 16 years ago now. Since then, we've invested about $3.6 billion in more than 50 infrastructure secondary transactions. And through those transactions, we are providing liquidity to investors in the private markets. About half of what we do is buying limited partnership interests from motivated sellers. And the other half is what we call non-traditional secondaries, so things like continuation funds, which allow general partners, the owners of assets, to retain control of their best opportunities, their best assets, while providing a liquidity option to their LPs. And we think that this secondary access route into underlying infrastructure exposure can be very complementary to the direct business. You know, typically we're acquiring mature portfolios of diversified brownfield infrastructure assets that can provide for meaningful day one yield and nearer term realizations, because we're entering these portfolios at a later date, often when they've been de-risked under the ownership of the existing GPs, either from an operational or a development phase or a capital structure perspective. And typically we're able to capitalize on some of the market and transaction dynamics, as I mentioned, from motivated sellers to acquire these portfolios at discounts to NAV. And by doing that, we're able to acquire what we think looks like core or core plus risk profile assets, but generate what looks like a value add type return while maintaining that day one yield component. And so the secondaries part of the portfolio here is going to provide that diversification across vintage years, strategies, sectors, GPs. It's going to provide nearer term liquidity, and we think a unique opportunity to capitalize on dislocations in the market, which I think sets this product apart from others and is complementary, as I said, to the direct activities.
And Graeme, the other thing I would add is in terms of the direct strategy of our mid-market value-add infrastructure fund, being part of Goldman Sachs is also a huge differentiator. So we have been doing infrastructure at Goldman for nearly 20 years. We've invested over $16 billion of capital into infrastructure during that time period. And we seek control or co-control positions given our value-add focus. So we are very active and hands-on investors. So being part of Goldman helps in several different ways. First, in terms of deal sourcing, access to our colleagues and other parts of the firm within the investment banking division, the insights and knowledge we get from our research team as well. Just a few examples of being part of the Goldman Sachs ecosystem really helps. Also within the alternatives business, we have a range of portfolio companies that operate across sectors that can be both customers or vendors or suppliers of the investments that we make out of infrastructure. In terms of our ownership, we are very active. We have the Goldman Sachs Value Accelerator that we'll talk a little bit about later, that provides a very hands-on approach for us to deliver on our value creation plan. Sustainability is also a big focus, and being part of Goldman is a key differentiator. This fund actually is going to be an Article 8 Plus SFDR, and we believe that sustainability really helps and is integral to the value creation strategy and the asset management, and really help enhance the performance as well of the investment that we make. And then last but not least, there is very strong alignment between Goldman Sachs and our investors and the investments that we make, since both the Goldman Sachs balance sheet and its employees are actually a material portion of the fund that we invest out of. So when you bring all those elements together, we truly believe that in terms of our direct strategy, we are the most dynamic and best resourced mid-market value-add infrastructure fund out there.
So that leads to my next question, which is about the current portfolio and then how it will evolve, the current portfolio with primary co-investments and how it will evolve with secondaries and managing some liquidity as well.
So, Graeme, we have the initial 10 seed assets across the 4 verticals that we invest out of from the direct infrastructure fund. We will keep investing across those sectors and across geographies. Our fund is a global fund, mostly focused on OECD, so that means Europe and North America mostly. And we will target about 4 deals a year out of our flagship in-market value-add infrastructure strategy. And that will be a good complement to what Henry and the secondaries team is going to do on their end.
Yeah, that's absolutely right. So on the secondary side, we expect to start making secondary infrastructure investments shortly, which will go into this open-ended fund. Those investments, as I mentioned, are going to be very diversified, typically core and core plus risk profile assets. Again, following some of the same thematics that Cedric is looking at on the direct side, but with additional diversification and the overlay of the cash flow profile of secondaries. And that involves mitigation of the J curve, because you're coming in later in the life of these underlying assets. You're often coming in at a discount to NAV. So you expect that day one yield component. You expect often a discount recapture, so a markup early in the life of the investment, because we're often able to buy at a discount to NAV. And then you expect these nearer term realizations, because, as I said, you're entering later into the fund life of these underlying private infrastructure funds. And I think that all of that taken together can add a very complementary cash flow profile to the overall fund.
So that's really interesting how the portfolio evolves. Taking it back to our clients who are investing early, what are the advantages for our clients in investing early in this fund?
Yeah, look, I think there's clearly, as Cedric has mentioned, a fully formed portfolio day one. I think in addition to that, investors that are in the fund are going to benefit from some of the secondary deals that we do early, particularly if those are at a discount to NAV. They will benefit from that discount recapture. And so I think that coupled with the market opportunity that we see today across both direct and secondaries in the infrastructure space, I think makes this a very interesting opportunity and interesting moment to be investing in the space.
Looking at the operational improvement that you can do, that really resonates with us, because we look at middle market value add strategies with a strong operator input. The Goldman Sachs Accelerator is one way that you do that. Can you explain a little bit more about that?
Of course. So the Goldman Sachs Value Accelerator is really a network of about 100 operating advisors that work across the Goldman Sachs alternatives business. So that's infrastructure, but that also gives us the benefit of the experience and expertise they acquire by working across private equity growth and other verticals. And those advisors really stay engaged from the very beginning of a transaction. They help us actually through due diligence, then during the ownership phase, up until exit effectively. And so it's truly a partnership model with the management teams of the companies and assets that we invest in. And I would describe it really as a pull and not a push, which is really important because in terms of actually developing the value creation plan between the Goldman Sachs infrastructure deal teams, the management teams, and the value accelerator, you really generate true buy-in, ownership, and accountability that really helps drive value throughout the ownership. The value accelerator really can be hands-on across a number of verticals. We call them centers of excellence. So that includes, for instance, tech, data, and AI, which is obviously very important these days. That also includes operational excellence, for instance, but as well as finance and strategy, sustainability and ESG optimization, talent and organizational strategy, which is a key component, and then last but not least, scaling revenue. And so working through all those aspects is ultimately what helps us really deliver on that value. And I think one component that's quite important is when we talk about value creation and adding value, that means growing businesses over time, but it can also mean that when challenges come up, you really have multiple levers you can pull to actually mitigate the impact of those potential challenges. And so that makes those businesses and those investments that much more resilient. So it's both the resiliency of the businesses and the growth that the Goldman Sachs Value Accelerator really helps us deliver on.
We've talked a lot about the strategy and how that will evolve over time in the different elements. Perhaps let's talk about an example of a primary transaction and a secondary transaction, just to bring the strategy to life a bit more.
Yeah, for sure. So I will mention first a primary transaction called Bright Night Power that we actually closed in October of this year. So Bright Night Power is a $440 million strategic investment that we made out of our flagship fund in a company called Bright Night that is really focused on utility scale renewable power, energy generation and storage. And so they own and develop projects throughout the United States. And they partner with utility customers while doing so. We think the tailwinds for this business are quite significant. You really are seeing right now a potential increase in power demand in the US, driven by reshoring, onshoring on the manufacturing side, but also data center and AI growth that can be quite interesting over the next several years. So we're quite excited about this investment because it was really the culmination of a 2-year sourcing process that we went through to really find an attractive opportunity given the fact that the broader market has adjusted to today's environment, which means higher interest rates, supply chain congestion, bottlenecks around the electric grid in the US. And we found a great entry point with both a structure to the investment that we think is really differentiated and also a governance framework that really fits our mandate as a control investor. I would just add as well that the company was founded in 2018 by Martin Herman, who is really a pioneer in the renewable energy space here in the US and has over 100 employees today. And so talking about value creation, we think we can really partner with the team over the next several years here to really deliver the best of Goldman Sachs to them as well. That means optimizing the access to the capital markets for debt and tax equity financing, which is very important for renewable projects, especially these days, and also leveraging the Goldman Sachs ecosystem to help with access and relationships to potential customers and suppliers. On the customer front, it can be with digital customers, hyperscalers, and utility customers as well. And we think this really will benefit the Bright Knight Power team, and it's going to be a good journey for us with them.
And on the secondary side, a good example, I think, is actually the largest infrastructure secondary deal that we've undertaken to date. We call it Project Amazon. This was a more than $500 million transaction, actually buying from an Australian superannuation fund. The superannuation fund was looking to reduce some of its fund commitment exposure to focus on the home market here in Australia and to focus more on direct investing. The process we participated in there, we were able to acquire a portfolio of 2 limited partnership interests and 3 co-investments in really blue chip global infrastructure managers. And we were able to diligence that portfolio because the general partners of those funds were willing to spend significant time with us to help underwrite the underlying portfolio. And that's really a result of, first of all, our relationships with those managers, so having been in the secondary market in infrastructure for more than 16 years, through the relationships that our broader open architecture platform had with those managers, as well as the broader Goldman Sachs relationships. And we were made aware through the process that those underlying GPs only spent that time with a very small number of potential buyers. The portfolio also had a couple of esoteric assets in there that were quite hard to diligence. One in particular was a Brazilian pipeline asset. We're fortunate that Goldman's has a large presence in Sao Paulo in Brazil, and we were able to leverage the on-the-ground expertise there to help us underwrite that portfolio. And ultimately, we were able to acquire what we think was a very core and core plus risk profile portfolio for value add type returns, and to come in at what we felt was a very interesting rolled forward discount to NAV at closing. And that transaction is off to a great start.
One thing that we think is really exciting about the Bright Knight investment and the company itself is its pipeline of projects. So they have 31 gigawatts of both solar generation and battery storage projects across the US. And what's quite differentiated about them is the interconnection positions that they've been able to secure along the electric grid at multiple locations across the US to support those projects, which should make those projects quite attractive and really deliver on the value creation for the years to come.
Thank you for that. So that's quite a deep dive into a couple of assets, one primary, one secondary. So a final question, why is now a good time to invest in this strategy?
Yes, absolutely. Graeme, I would say that right now, we're probably in the golden age of the mid-market value-add infrastructure strategy at this point in time. And I think that's here to stay, actually. This space, especially the mid-market, is less crowded than other parts of the infrastructure space, for instance, than the large cap space, I would say. If you look at all deal sourcing on the direct side, I would say that about 75% of our investments are either proprietary or coming out of limited processes, and so that really puts sort of into action the selectivity and the opportunity that exists in the mid-market today. The other thing that I think makes the mid-market really attractive right now is the opportunities for entry at interesting valuations, and then at thinking about exits as well, where maybe unlike large cap, for instance, you have the opportunity to sell to multiple types of buyers, and you have a pretty deep buyer pool. That can be strategic players who want to acquire those businesses to add to their existing offering or create a new adjacency, or it can be large cap infrastructure funds that then want to get into those sectors and use those investments as sort of anchor. So you really have optionality both at the entry and then at the exit. And then the last point I would say is really just around the value creation. If you think of our direct strategy, about 2/3 of the value we create throughout our investment and the hold period really comes from EBITDA growth and cash generation. And so that's really differentiated. That makes the mid-market value add really interesting and deliver value for investors.
And on the secondary side, I think that what we see in secondaries today is a real structural supply-demand mismatch. So the buy-side secondary buyers like us are just not able to raise capital quick enough to fulfill the liquidity requirements that limited partners are looking for today. As many of your investors will know, distributions have slowed down from some portfolios. This has created a need for liquidity, both amongst LPs as well as GPs looking to increase DPI distributions from their funds. And this supply-demand mismatch is very acute. So just to put some numbers around that, last year we sourced about $40 billion of infrastructure secondary deal volume. The market globally closed between 12 and 13 billion. So less than 1/3 of the deals that come to market end up getting closed. And that just shows how selective we as buyers can be. And that is reflected in the discounts that we're able to acquire these portfolios at. In our most recent closed-ended infrastructure secondary fund, those discounts have been in the range of 15% on average. So I think we're able to capitalize on some of the market dynamics that we see to buy at interesting discounts, to NAV.
Thank you, Cedric and Henry. This was a discussion about the Goldman Sachs West Street Infrastructure Fund. And please contact your financial advisor or Partners Private Contact.
Thank you, Graeme.
Thank you for having us.